let's talk some more about what's in store. We still got one more day left this week, and it may not be a big earnings one because it's a Friday, and that means fewer numbers in the afternoon. But Scott Bauer joining us from Prosper Trading Academy. You were right here last time I saw you, Scott, so you're a man on the move, okay? Yeah. Is our economy going to be on the move tomorrow when we see that GDP? Tell me what you're looking for. Is this a big deal?
Yeah, I think every big number that comes out, almost like kind of what we saw this morning with durable goods, every number that comes out right now is a big deal because the economy is being so micromanaged. So, yeah, it is. And you know what? I expect a hotter number, and I think that the economy is firing. I don't want to say firing on all cylinders, but it's moving along very well. And we have seen some numbers recently almost outside of that Goldilocks box that we've seen. A few numbers that have been hotter than expected. And Oliver, I've gone out on a limb. You and I have talked about this. I actually think that, you know, later this summer, maybe in the fall, the Fed is going to start hinting towards a raise in rates, not a decline. So GDP is going to be a big one. Let's see what it is tomorrow. I mean, we got the revisions out of Goldman, right? So let's see what that number is.
Yeah. You know, this is, to me, I like that you bring up Goldman. I like that you bring up the fact that there's a potential for maybe some recalibration of the language from the central bank, right? JP Morgan also. Atlanta Fed, I mean, you know, flip a coin, Atlanta Fed goes one direction or the other. But the idea here is that there's all this articles, you know, coming back to the surface, Scott, about not only that the market still wants a cut, but that there's like these anomalies in different interest rate regimes that are happening between the Fed funds and, you know, overnight rates and all this type of stuff that says, you know, there might even be an imminence of cut language. And it's just, I have trouble with the hard data to arrive at such a conclusion.
I can't see it. I can't see an imminent cut here. Now, you do bring up a really good point that the dollar is the only game in town when you're talking currencies and you're talking rates. In fact, I think what you're referencing here is you know, an article and some news that came out today about how big funds are looking at the dollar and saying it's really hard to short it here because of what's going on elsewhere in the world with other currencies.
Yeah. All right. So let's talk about this a little bit here because this is really interesting. This kind of happens a lot when we've had these moments of you know, negative rates and stuff where kind of strange things happen in the market, Scott. As we search for explanations for the dollar, you know, from a 30,000 foot level, it's, hey, look, our system is better than other people's. But that actually manifests itself in a pretty interesting way in terms of actually the cost of someone to basically make a bet that the dollar goes down. Do you think that maybe is playing a role here at all?
There's no question about it because of this big disparity that we're seeing, especially in the short-term rates, like in the 90-day, the 3-month rates here. What's happening is the carry trade, right? So people are going in and they're, you know, getting funds from the euro. They're borrowing the euro so they can buy the dollar and invest in the dollar because it's such a big difference. I think that 90-day swap or that 90-day difference is over 300 basis points between the dollar and the euro. So yeah, that certainly has some tailwinds behind what's going on with the dollar here. And like I said, for right now, it is the only game in town. And you know, I don't know that our system in a perfect world is the best system. But right now, it's certainly playing out that way when you compare what's going on here versus the rest of the world. You know, we got news out of Japan overnight saying how bad things are there.
Well, you know what I thought was funny about that is that the yen rallied because they put like a 2020 date on it. All you have to do, the relative difference, right? The marginal, you know, rate of, you know, hawkish increase is very small. And I wonder if we're at that point too where the Fed doesn't even need to say they have to hike. They can just go, hey, look, we're not going to cut yet, and who knows what that means for rates? I don't know. And the point there, Scott, is that if any reversal has to happen in the dollar, so to come back to this, okay, given what the environment is right now, I would think it might even be a sharper move if it happens, because then if you were an investor who wanted to short this thing, but it's expensive, and you go, okay, well, this is going to change pretty quickly. Now I actually have a means to do it.
No question about it. And I think we're seeing, like you just said, we're seeing less and less shorts out there. People really just buying in, no pun intended, buying into the upside of the dollar here. But, kind of circling the wagons back here to the GDP tomorrow and the rest of the economic reports, if these numbers but they continue to underlay the economic conditions here, that not only are things not so bad, not only are they not slowing, but they're actually starting to tick up and starting to accelerate, man, oh man, we're going to have an interesting dilemma on our hands in the next few months, or as we get into Q3 this year, between the Fed and what may happen with the dollar.
Yeah. All right. It's going to be a fun one, Scott. So GDP tomorrow, look, it's got a lot of implications in a market that's still trying to make sense of the economic situation. Paranoia in December, but then, a flip to that now. So maybe we'll get another piece of evidence. Scott Bauer is the CEO of Prosper Trading Academy, joining us from the CME floor. We'll be right back. Time to talk some earnings.